All right, what's up, boys? So this week things are gonna get a little bit more interesting for everybody that is trying to learn order flow. We talked about auction market theory. We talked about the volume profile a little bit. Talked about the basics of order flow. Now what we're gonna talk about is the key levels that we're actually gonna use for trades. So every single great trade has three things. It is the context of the higher time frame. It has a location of interest, which we're going to talk about today, and it has confirmation, which is what we use the order flow for. We use the order flow for confirmation. So that's a rule that I took from Carmine Rosado. I think he might be the one who came up with it, the CLC rule. I'm not really sure, but that's straight from him. The context, location, and confirmation, and I couldn't agree more. Every single one of my trades that win, I look back at them, and they have all those things. So it's not a joke. And in this video, we're just going to talk about how we can find the key levels. And then in the next video, after this one tomorrow, we're going to talk about how can we use these key levels to create a plan for the session. So let's just get right into it. You might be wondering right now, what key levels are we going to be talking about? So these are all the key levels that I use in my own analysis. Now, one thing I want to say before I get into all of these levels is that the way I trade, I scalp, okay? My average position is going to be anywhere from 5 minutes to, on the high end, 30 minutes long. So if you're here looking for higher time frame swings, or if you're looking for longer term day trades, you're in the wrong place. If you're looking for scalps that are similar to what I just mentioned, where you're just looking to catch a piece of the pie, you are in the right place, okay? So just keep that in mind. All of this moving forward, if you're trading order flow, I'm pretty positive you're going to be scalping. So most of you guys are probably in the right place, but I just need to preface that if you're looking for like swing trading or day trading, like longer term trades, not in the right place. Another thing that I want to say is that as a scalper, the most relevant points of interest for us is the most recent levels, okay? I'm not going to be here marking out a level that's 200 points away from where we're trading at when we open up on a session. It makes no sense. The levels that I care about, since I'm only going for like 10 to 15 points on ES, I want to be able to play a reaction off of one of the closest levels near me where we're opening up at. So just keep that in mind. We are going to focus on the most relevant levels. We're going to be focusing on the most recently developed levels. This isn't something you got to go into your chart and just mark the whole year out. Like, you don't need to do that if you're scalping like I do, at least. You want the most significant levels that we're trading around. If we were to go up or go down into old historical levels that matter, that's a different story, and we will mark those up as we trade closer to them. But just think about it, use your brain. Like, it makes no sense to mark a level that's 100 points away, right? It makes no sense to mark a level that's not close to you that you're not going to get a reaction off of that day, okay? Like, most of the time for me to create a plan, I only need the past week of data. Now, these are basically the levels kind of in order of how I use them. So first, I'm always looking for supply and demand levels. Then after I find supply and demand levels, I'm going to the volume profile. And I'm also using the opens, highs, lows, and closes of sometimes the weekly, sometimes the daily. So I'll get into all of this in this video. And we're just going to break all of these down in their simplest form, and I'll show you guys a couple examples. So first off, let's talk about supply and demand. What are supply and demand levels? So a supply or a demand level, they come from a period of consolidation followed by an impulsive move. So obviously, we'll do the demand levels up top right here. So this area right here, where the move initiated from, this would be a demand level, okay? It can also look like this. Say we have a move up, and then we consolidate, and then we have another move up. This would be a demand level right here, in this zone right here. You can also have a drop, consolidation, move up. This would be demand as well. Really, all it is a period of consolidation before an impulsive move. I'm probably going to have to repeat that a few more times, but it's the same thing to the downside. Those are the demand levels. If I come down here, scooch this up, now we'll talk about the supply levels. It's the same thing in reverse. So you can have consolidation, move down. This would be a supply level. You could also have a move down, consolidation, a move down. This would be a supply level. You could also have a move up, consolidation, move down. That'll be supply level. So it's a little repetitive, but it's very simple. That's what a supply and demand level is. So like the most perfect looking example, I'll just give you guys a supply for an example. Like you'll see a candlestick chart. This is a green candle. We'll shade it in because it's green, okay? And then we have a red candle that follows it. It'll be like that. So this would be a basing period, right? This would be what consolidation looks like in a candlestick, followed by an impulsive move down. This would be your supply level right there. That's how you would mark it. And what I was getting to with this drawing is that it's not always going to look picture perfect. Like some people are going to look at this and they consider it what is called, and they'll consider it like an order block or something. All I wanted to make the point of with this little drawing right here is sometimes it can look a little less clean than this, but all you have to think about any period of consolidation followed by an impulsive move. So we're looking for recent formations of these levels as areas of interest, okay? So I'll just pull up TradingView right here and we can mark out a few examples. Now the way you're gonna find these is you're going to go from the top down, meaning I like to start at the daily. And what you're going to do is you're going to look for these levels on the daily chart, and then you're going to work your way down the time frames. Obviously, the higher time frame the level is, the more significant, or the more powerful, I should say, it will be. So boom, there's a pretty clear demand level right here, right? This would be, so this could be a demand level. This could be a demand level. I don't see any supply. I don't see any supply levels around us at the moment, but you guys can imagine what it would look like. I mean, on the daily, but yeah, you can see it's just like I said, it's a basic period followed by an impulsive move up. So you're going to work your way down the time frames and you can refine these as you go. So these are both dailies, obviously. Then I come down to a 4-hour. Do I see any that I missed? Not exactly. Go to a 2-hour. So like this right here would have been a supply level that got broken. And you can see it kind of retested and held at this point. You guys can get the picture. We're going from the higher time frame down to the lower time frames, all the way down to a 30-minute chart. And now right here, here's an example of what I would consider a demand as well. So like, I would definitely mark this out. And you're just marking these all the way down. So the same thing in reverse, like I've said already 4 times, supply levels are the same thing in reverse. We just don't have as many. That's my first focus. Mark out the supply and the demand levels on the chart first. So the next levels I'll talk about is on a volume profile. So if you remember the volume profile video, we have LVNs, we have high volume nodes, low volume nodes, high volume nodes, and then you can have shelves, edges of value. I'm just going to tell you guys right now, the most I focus on are the low volume areas, okay? The others are just a little bit less relevant for the way I trade, and I will explain more about that when I talk about how we can use a plan. I'll pull up a weekly profile and then I'll show you guys a daily profile after that. So here's an example from last week. So this is the week that started on August 9th. This week that is barely starting, since I have this as a replay chart. This is going to be last Monday on the 18th right here. So coming into this week, we were just consolidating at all-time highs. And the only supply and demand levels that we had was just demand at 420, or I'm sorry, was just demand right here around 432. And then we had another one down at like 422 or 424. So we were consolidating at all-time highs with no supply and demand near us. So whenever this happens, I would like to use the volume profiles more, or the previous session's context, to put together a trade thesis. And this is where I start using levels from the volume profile. So I already have them marked out right here. But what these levels really are the edges of value of where we are consolidating at all-time highs. So you can see how the volume drops off right here. I would mark it right there. Volume at top, and then on the top end, the volume drops off right around the 96s. So this is essentially what it looks like on the chart. If I were to show you guys this time period that I'm speaking about, this balance range right here is what I just showed you on that weekly profile. And these are the demand levels that I had that I was mentioning earlier. So we did not have anything up here in this balance range as far as supply and demand. So this is what I'm talking about. You want to align with the higher time frame context and then find locations within that. So what's the context for like this Monday, for example? The context is we are opening up inside of this balance range. So balance range rules apply. What are the most significant levels within a balance range? It's the high of it and the low of it. At the low, we want to expect buyers to step in. At the high, we want to expect sellers to step in. And we do not want to try to get short at the bottom of the range unless sellers break it and show acceptance below. Same thing to the upside. We are not looking to get long at the top of the balance range unless buyers break above and show acceptance above the range, okay? Now, if I take it down a little bit smaller even, so on the weekly profile, we can see, all right, we are in a weekly balance range, right? This range is like 30 points. So we can come within this range and look for points of interest that might have formed from this Friday before the Monday. And we can use this as context to what's happening on top of the higher time frame context. This is when I would come over to a daily volume profile and start trying to formulate something from there. I already know that on the higher time frame, I don't want to get short down here unless this level breaks and sellers accept lower prices. So the first thing I'm doing, and this is right before that Monday open on the 18th. So the plan for this session was, all right, I do not want to get short unless this level breaks. If we break the balance range low, I want to play short down to the demand levels that I had at 33 or 32 and 24. Only if this level breaks. The main idea of this session is going to be, I want to look for evidence of strong buying at the bottom of this balance range to get long, targeting this high from Friday or Sunday night, which aligns with this low volume area that I have marked out, which formed on the last Friday. Another way you could use this low volume area is you could say if buyers came up and accepted prices above this area of low volume, then you could look to get long, targeting the all-time high or the top of the range. So that is how I would use these levels, okay? Sometimes there's not going to be sometimes there's not going to be enough supply and demand levels that are close to you that you can actually play off of. So you just have to understand the higher time frame context and then understand the previous few sessions context, find key levels of interest or inflection points, and use those to create if-then statements to create a plan. And creating plans for the session is like one of the best things you can do because think about it. What are you doing whenever you find levels of interest and create a plan around them? You are aligning yourself with the higher time frame and you're forcing yourself to only make decisions at key areas where significant activity already occurred in the past. So that's pretty much how I use the volume profiles. I'm looking less at the higher time frame profile than I am at the daily profiles because since I'm a scalper, since I'm looking for short, quick moves to catch a piece of the pie, I don't need to look at the higher time frame. I want to look at the most relevant, the most recent activity that has happened, play based off of reactions of the most recent activity while also aligning with the higher time frame narrative as well at the same time. That is going to allow you to take the most high probability setups. A lot of people get caught up on trying to predict if it's going to go long or short during the open without any significant activity even happening. And that's how you get burnt on low quality trades because you might be right about seeing a little bit of something, right? Like you might see a little bit of something, but if it doesn't align with the higher time frame context and it's not at a location where a ton of people want to transact it or where there's going to be a reaction at, then you're putting yourself at a lower quality trade. Now the following levels that I'm going to use, so that's, like I said, that's how I use the volume profile. The next most important levels that I use are the open, high, the low, or the close of a certain time. Maybe it'll be the week, maybe it'll be the day. Most of the time, it's one of those two things. Here's the example I was just telling you guys about from Monday on the 18th. So this session ended up being balanced and I took no trades this day because we didn't break the balance range low. Buyers didn't reclaim up here and show acceptance in this low volume area. So I had no edge really. I just had no way of I had no place to trade at. There was nothing for me to do. Like it's simple as that. Sometimes there's going to be days like that. Now, the following day, you can see the location that we're at is very similar to that Monday. But there is one thing that's different, and that's the fact that the last session, which is Monday, was very balanced. Like you can see how balanced this session was right here. So here is where the highs and the lows, for example, are going to come into play as levels of interest. Since we're damn near in the same location and we have the same areas of interest that I just explained to you for the previous session, we can kind of take the plan from yesterday and refine it to fit this session a little better. So what I would do is it's the same gist. Like I don't want to get short unless this balance range breaks right here. And I want to first look for strong buying at the low of the balance range to take it up to, in this case, the best place to take it up to would be the yesterday's high. So the high and the low of this session would be significant to me because it was so balanced. If we break out of yesterday's high or the low, I look for acceptance above or below them, or I want to look for responsive activity at the bottom of the range or the top of the range. So here's the overnight. You can see the overnight, we swept yesterday's high, auction market theory at its finest right now, and we come all the way down to the opposite end of the value area. Same thing right here. We take the low, responsive buying shows up, come all the way up to, and then we come back into balance. Now, whenever this session opens up, we swept the previous day's low, and we found in this case there was actually absorption followed by buyers taking control right here, and that was a great setup to take it long at the bottom of this range right here, which was yesterday's low, to take it up to yesterday's high. And the same thing happened here. Buyers get trapped, and I'll show you guys these examples specifically later on in the series, but buyers ended up getting trapped up here. Sellers said, hey, this is a great price to sell at. They started selling aggressively. Finally, after this move, we came down below, we broke the balance range, and then we transacted volume showing acceptance below that balance range. And this is where we can say that short setup for continuation down to that demand level at 32 first and then 24 would have been a perfect setup. So while I'm telling you guys supply and demand levels are my first focus, I'm not always going to have supply and demand levels to play off of. And I'm going to have to use other things like volume profile analysis and the highs and the lows of the previous session to actually make decisions. And we don't just go long at demand or short in supply. We need to have confirmation as well. And we need to have a plan created around these levels for them to make sense to us and for us to actually put ourselves in the highest probability of taking a winning trade. So in the next video, I'm going to show you guys how you can use levels to create a pre-market plan. And if you want to see my pre-market plans before every session, hit the description below. There's a free Discord for the order flow Discord, and you can tap in there. So that's going to wrap it up for the key levels video. If you guys haven't subscribed yet, make sure you subscribe, like the video, and I'll catch you guys in the next one.